Don't forget, you can reach the latest episode of Potomac Watch anytime. Just ask your smart speaker, play the Opinion Potomac Watch podcast.
From the opinion pages of the Wall Street Journal, this is Potomac Watch.
Welcome back. I'm Kim Strassel here with Barton Swaim and Alicia Finley. The latest round of inflation numbers have a lot of folks, shall we say, concerned. Inflation has certainly slowed from its 2022 peak, but Tuesday data nonetheless showed that the Consumer Price Index climbed 6.4% in January compared to a year earlier, faster than had been forecast and only slightly less than the 6.5% in December. That's still about 3 times faster than the Fed would like to see. Its target is about 2%. And more importantly, prices really continued to rage in a number of key areas. And backing that up, we got some pretty strong retail sales numbers today. Alicia, can you walk us through what this latest round of data means?
Sure. So I think there's actually a lot of people are debating on what this data means and trying to take into the context of what were the economic data that has been coming in recent months, which can be a little noisy. For instance, last month's job report showed pretty strong job growth. Today we have pretty strong retail growth in terms of sales, but in December we actually saw a big decline in retail sales, which led a lot of people to believe that the economy was slowing down. But the more recent signals that we're getting now is that, the economy, the job market are still pretty strong. Retail sales are going strong, which will continue to push up demand for services and goods and contribute to, increasing prices. And we're seeing this in the latest inflation report that inflation is starting to slow down. As you said, it's about 6.4% over the year. And that's mainly that top line number. And a lot of that has been because, energy prices have started to decline. But if you look drill down, you actually see that the food prices again are rising pretty fast, 0.5% just in January. There really hasn't been much slowdown there, maybe a little bit since over the summer. Services, shelter in particular, the rents are still rising at a pretty fast rate. I mean, there's a debate whether, the measure that the BLS uses to calculate the shelter index actually has a lag, and so we're actually seeing some rent prices fall in many regions, and the report doesn't take that into account. But what I also consider very dismaying is we're actually seeing still pretty strong increases in other services and goods. And these were, used car prices have started to fall, but a lot of other goods, prices like clothing, medical care commodities, and those kinds of things are continuing to rise. And we were actually expecting that to fall, and maybe services would continue to increase amid wage pressures. And as the pandemic has eased, more people are going out, traveling, the demand has increased for restaurants, hotels, and all of that. And so maybe there would be, continued upward pressure in the service index. But we're also continuing to see that in the goods index. So I think it shows that the Fed still has a long ways to go to, bring inflation down.
Yeah, I agree with you on that. I think if there was one clear message that came out of an otherwise very muddy report, it's that we are not there yet, and the Federal Reserve is going to have to continue to take actions. I think the market finally took that on board, perhaps a little bit this week, because they certainly didn't respond very happily to these numbers. I just want to drill down a little bit into a couple of the areas that you mentioned, Alicia, because, we tend to talk about these things clinically, but they really do highlight that this inflation that we're seeing now has been really painful for consumers in a number of ways. You mentioned the grocery bill. That number is quite astonishing. Even as overall U.S. prices fell slightly, as we noted, grocery prices, what people buy at retailers to take home and prepare their meals, jumped 11.3% in January from a year earlier. And by the way, if you've been to a grocery store, you would know this, especially if you are like me, you have a teenage son who has the ability to empty the refrigerator on a daily basis. And that's really hit families hard. But the other one, Barton, is home prices. As the Federal Reserve does raise interest rates, that's obviously fed into mortgage costs, rental costs. Home prices were up 6.9% in December for the year. And I think that broad number kind of really doesn't do justice to what that means to average Americans. Their inability to sell a house if they need to move, the trouble for younger people trying to get into the market. Barton, what are we seeing out there in terms of housing and some of these household good prices in particular?
I think housing is a huge part of what's driving this. And if I could just sort of look at this from 30,000 feet, the pandemic taught a lot of companies and a lot of individuals that they could work from home. And when people are all working at home, they naturally want to make really expensive improvements. A lot of them. They want to move into bigger homes. That's going to drive up prices. And that's okay for a certain segment of the economy that can live a little more comfortably. It's not so okay for people in the middle and lower income levels who need to find better housing situations for whatever reason, a better school district or safer neighborhood, whatever. And when prices go up, they go up for everybody. People in the middle are feeling that. At the same time, what we haven't seen in the last several quarters is much in the way of wage growth. There's some, as you would expect, workers are putting pressure on employers to raise their pay to cope with inflation. But wages aren't keeping up anywhere near keeping up with inflation when it's at 6.5% or whatever. And in my view, this is a long reverbation of the shutdowns of 2020, 2021. When government shuts down the economy and tries to keep it going with lots of borrowed cash, the effects are going to last well past the crisis itself.
Yeah, and that gets us back to the Fed, Alicia. For me, as we just talked about, it would seem that this report would be a very strong indication that the Fed really needs to keep its foot on the gas here for a while and get some of this under control. That being said, there's been an interesting debate that's been breaking out, including on our own pages, is the role of the money supply in inflation. Some of our own contributors predicted that the huge increase in the money supply, which is shorthand known as M2, in 2020 would lead to higher prices, albeit with a lag. Now that we're seeing this sharp contraction in money supply, they're arguing that we are soon going to see a sharp bout of disinflation, and they're now beginning to worry about a recession. This is kind of adding to the pressure for Jerome Powell to pull back a little bit. We at the page over the years have lost a little bit of our confidence in the M2 as a reliable inflation predictor. Alicia, what are your own views on that? How should people sort through this in their head?
I think there is a lot of uncertainty. That's why the Fed has actually slowed its increases in interest rates and is not likely to raise them as much as many expected last year. I mean, many people are expecting the ultimate terminal rate, which is the term that's used to describe the basically endpoint or how high the Fed is going to eventually have to raise interest rates to keep them or to keep inflation and reduce inflation down to 2%. And many people are expecting that to, range from about 5.1 to maybe 5.6, though some are actually thinking maybe it has to be 6%. And I guess it really depends on how you read that M2. Well, yes, the growth in the money supply slowed and started to decline. But I think there is a case that, we saw in the last decade that, M2 really didn't predict inflation all that well. And there's still a lot of the money supply is still very large. People still have a lot of savings that will continue to flow into the economy. We really aren't seeing as much of a slowdown, and as the Fed has expected from the interest rate increases. The Fed seems to think, there's the Phillips curve, that there's a balance and there's an offset between inflation and unemployment, and, inflation still continuing to rage. Unemployment really hasn't increased. In fact, the jobs report, as we mentioned earlier, was really quite strong. And, the job openings are actually, grew last month by around 500,000. So I think part of the debate is really a philosophical debate about monetary policy, but part is just actually how do you read and interpret these conflicting signals. And I think that that's going to be a continued debate that we have over the next few months. The Fed has basically kind of taken over as in seen its job as, stimulating the economy. And I think that was a mistake, especially with the problem was the pandemic shutdowns and the virus itself. It wasn't a problem of monetary policy. So I think the result that we're seeing is that inflation is continuing to grow, even if it's starting to slow down a little bit. And what happens, in the next few months, I think the Fed just has a hard time. We'll have a hard time over the next few months, and we'll probably get a little more clearer view of what's going on with more economic reports, more jobs reports coming in. I would expect the jobs increases to slow down, and maybe in a few months, they actually see declines. So it's possible that we have a recession, later this year. But right now, I think there actually isn't much evidence that that's going to happen.
Yeah, all of which brings me to the thing for which I am grateful every day, that I am not Jay Powell. Anyway, I want to thank you, Barton. Thank you, Alicia. Thank all of our listeners. I want to remind them that we are here every day. We'll be back tomorrow with another edition. You can email us at pwpodcast@wsj.com. And if you like the show, please do hit that subscribe button.